This is Unit 10 of Governmental Accounting and Auditing, Analysis of Governmental Financial Performance. So what is it that the people who use these governmental financial reports that we've now spent 9 weeks exploring and understanding how they're put together, and then last week looking at what is actually reported externally. What is it that users are doing with this information? This chapter really focuses on the practice of taking the information in the financial statements and from other parts of the financial report and trying to draw conclusions about the financial health of the government, or to inform other decisions, such as whether to buy a government's bonds when it sells them in the public credit markets, or how to rate its ability to repay those bonds, whether you want to move to a particular community, or send your kids to a particular school district. These are all things that, and many other things, that could be informed by looking at this information. The chapter begins by touching upon some of the key concepts in financial analysis, the major types of things that financial analysis would measure: the financial position of the government, in other words, where it stands financially at a given point in time, usually as of the date of the financial statements, and financial condition, a broader concept that is more forward-looking, trying to assess generally what a government's ability to meet its financial obligations as they come due is, their ability to raise sufficient resources to operate the government and to provide services. You should understand that when people are analyzing government financial statements, it's usually not just to understand where a government was historically. They're looking at that historical information because there's something they want to be able to assess going forward, like, will a government be able to pay off its debt in the future? Will it be able to raise sufficient tax revenues to fund its expenditures, and so on? So you're looking at historical data, but your interest really is, where is the government going, as opposed to where it has been. The GASB uses this concept of economic condition, which is a combination of what most people think of as financial position and financial condition. In fact, one of the components is financial position. And then there's fiscal capacity, the ability to deal with financial obligations, and service capacity, the ability to deal with service obligations. In other words, the requirement to provide the services that the government's citizens demand and require. There is a considerable discussion in the chapter on the approach used by the International City and County Management Association, or ICMA, where they look at financial health as 4 different types of solvency: the ability to raise sufficient cash in the very near term, the ability to raise sufficient resources over the period of the budget, which usually means over the next year. Then looking much further into the future, will they be viable in the long run? And then, are they able to provide the services that are required? Do they have the financial and non-financial resources necessary to meet service demands? ICMA uses those concepts as a part of its financial trend management system, or monitoring system, or FTMS. And theoretically, they're looking at a variety of environmental factors. So what's going on around the government as it operates? How does the government respond to that through management practices and legislative policies? And therefore, then, what are the financial factors that result, and which can be measured using ratios and other indicators to tell you whether the government is doing well or doing poorly financially. And their financial factors fall into these 6 groups: revenues, expenditures, operating position, which more or less means the difference between revenues and expenditures, and whether they are raising sufficient resources from year to year. their debt structure, so how much they have outstanding, their ability to issue more debt. Unfunded liabilities is talking about pensions and OPEB, and then the condition of their capital assets and their infrastructure, which is being used to provide service. There are a large number of financial ratios that can be used in financial analysis, and we're not going to get into all of them. There is a separate course that I actually designed for Rutgers, in which I teach. It's available in the fall semester, called Topics in Governmental Financial Analysis, where we spend the whole semester really getting into financial analysis in detail. But it suffices for this course for you to just have a sense of what these different types of ratios are. There are ratios of financial position, so measuring a government's financial status at a given point. Key among those are the liquidity ratios at the bottom there, current ratio and quick ratio. The current ratio being current liabilities divided by current assets, and the quick ratio being current assets divided by current liabilities. The quick ratio being only a subset of those current assets, usually just cash and current investments, maybe accounts receivable, divided by the current liabilities. So you're getting a sense of, in the very near term, do they have sufficient resources to pay their obligations as they come due. Financial performance, is looking at what happened over the course of the most recent reporting period, usually talking about a year, and what that says about the government going forward. So you're going to look at things like the change in net position, the difference between revenues and expenses, or fund balance, the difference between revenues and expenditures, perhaps dividing them by revenues or expenditures to give you a sense of essentially a percentage change. Self-sufficiency, looking at specific services, particularly business type activities, to see if they're raising sufficient revenues on their own to cover their own costs, or if a subsidy is needed from the general fund, or if that business type activity may be subsidizing the general fund in the other direction. Debt service coverage, you're looking at ratios that see whether there are sufficient resources to pay for interest and principal combined. And then financial capability is really telling you whether the government has the wherewithal to raise sufficient resources to cover its costs, to continue to provide services, to pay off its debt as it comes due. Ratios like debt per capita and taxes per capita give you a basis for making comparisons from one government to the other.